All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi everyone, I'm your host Paul Wankmueller. Welcome to Macro Corner, Blue Line Futures' own podcast, where we go over top things to watch over the week. Brought to you again, Blue Line Futures. I'm your host Paul Wankmueller. My first guest today on episode number 1 is Jannis Meindl. Welcome to the show, Jannis.
Hey, Paul. Thanks so much for having me on. I'm looking forward to go over this macro editorial that we put out on a weekly basis and ultimately put it into podcast form here. I'm really excited. Thanks so much.
Yeah, same here. And for everybody out there that wants to read the transcript, I believe it's on bluelinefutures.com. Is that correct, Jannis?
That's exactly correct. It goes out each Sunday to Blue Line Futures' brokerage clients, and it's later posted that same Sunday also on the website.
That sounds great. So let's dive right into it. So we've seen contract highs on the July futures contract for WTI crude oil last week. I believe 120 what was the high of that week. Oil's been in the news a lot lately. From your perspective, after reading the research that you put out, apparently, even if we find, a large oil field, that's really not going to make a difference. Tell me a little bit about that.
Yeah, for sure. So the narrative out there is that we just need OPEC Plus and other large producers in the oil field, in the oil production industry to produce a lot more and make new commitments on that front. But the reality is that crude oil that's being discovered and ultimately drilled also needs to be refined and put into distillate form. So oil, gasoline, heating oil, diesel, different sorts of distillates that need to be made out of that crude oil as from the input side. And the reality is that the U.S. has gone from about 250 refineries back in 1982 to less than 150 refineries as of 2019. So
Wow.
What we have seen is technology has improved along the way, but ultimately distillate capacity peaked in April of 2020 at around 19 million barrels a day. It's now down as of April of 2022, it's down to about 17.9 million barrels a day. So this is 1.1 million barrels a day less production capacity on the distillate front. And so even if we've had a lot more oil input, there would still be a question around, is there enough distillate capacity to turn that input into output, which is ultimately what's being consumed by the end consumer of the product, which is everyday households, which is all the truckers out there, everyone who ultimately uses energy. And what it's going to take is more investment and more money coming in on the supply side before this production constraint is ultimately resolved.
Let me take a wild guess. It's not like you can just go open up a new oil refinery. How long does it take to open up one of these plants?
The Chevron CEO, Mike Wirth, he was on Bloomberg just last week, and what he suggested was that it would take, of course, billions of dollars to get a refinery built and probably around 10 years to have it up and running. Interestingly enough, the U.S. has not built the refinery since the 1970s, so there's even a question around the engineering expertise that's still there. Since it's not been built for that long. It would take a lot of money, a lot of expertise, and a lot of retraining.
Yeah, I mean, I'll tell you this much. It even from a political level, there's no way you're going to get an oil refinery approved. Especially in my neighborhood, that's just not going to happen. So yeah. Thank you for that. All right, so let's move on to our next topic. If you're finished with that. If not, we can keep going. If there's anything else you'd like to add.
Yeah, I just wanted to add one more note here on the strategic petroleum reserves.
Right.
So we have gone from around 36 days of total consumption inventory on the SPR. So you divide the total SPR by how much oil is being consumed in the U.S. on a daily basis. So we
Okay.
were right around 36 days on that front, and we've run that down to 29 days now. So if the SPR does not get refilled and we keep running that down, the market will ultimately perceive that as an SPR put beneath the market the same way that risk assets had the Fed put for a long time. So that's something I'm watching rather closely here. Does the U.S. ultimately have to refill reserves at much higher prices, and is that going to put a bit beneath the market? Under the conditions of much less liquidity, what we have seen is that open interest has come down about 33% from 2021 highs in
Right.
crude oil. So that means less contracts, more impact on price. So it's going to be interesting for sure in the energy market. It's been something that I've been following and I'll continue to follow.
That sounds good. Thank you for that. So we're going to talk a little bit about, you hear it all over the place. I was at the supermarket over the weekend and, clearly prices are higher across the board. That thing that we like to talk about called inflation. Well, is inflation affecting citizens of different wealth statuses differently? Are the top 1% feeling it as much as the bottom 1%? I don't really know. What do you think about that?
Certainly, there is a large difference and a widening difference. So we look back in history and look at the wealth gap between the top 1% and the bottom 50%. That's as wide as it was last in the 1920s. So
Huh.
what happened back then was really, and I'm keying off of what Jeff Curry from Goldman and his commodities team have put out over the course of the last couple of months. Each time you have the wealth gap widening to the extent that it has, you have union formation. You have all sorts of inflationary forces that are demanded by the bottom 50% of the income spectrum. So right now we're at yet another point that's similar to the 1920s, and it's going to be really interesting how that's going to play out. What you can observe is that people in the lower income class are ultimately driving commodity prices, while the top 1%, those are the ones who drive financial asset inflation. So why QE and a lot of monetary stimulus has driven up risk assets so much is because that incremental dollar that's received by the top 1% ultimately flows into investments, ultimately flows into risk assets. That's much different on the lower income spectrum. And that's why that large wealth gap matters that much for commodities and the ways in which fiscal transfers in the future may or may not be spent. So my view is on that front that as there are more targeted fiscal payments directed towards the low income class, that money is directly going into commodities, and that's ultimately going to drive prices.
Gotcha. Yeah, I mean, it does make sense, and this there is a disconnect, with inflation this time around. Is that if you're raising interest rates, that's really not going to matter when you go to the supermarket. It's not going to be a big difference. Everybody still needs to eat.
Yeah, exactly. And I mean, the Fed can theoretically print fiat currency, but they cannot print commodities. And until there's more money that flows to the supply side and into commodities, structural issues will simply not be resolved. The Fed can engage with different sorts of demand destruction, but until there's more money flowing into commodities, we will have some structural issues for a long time. So it's going to certainly be really interesting. We have 11.4 million job openings. We have an unemployment rate of 3.6% as of the latest non-farm payrolls report from Friday. And what the Fed ultimately wants to do is they want to avoid a similar type of inflation on the services side that we saw on the durable goods side. So what you saw coming out of COVID really, and during the lockdowns, all the people ordered stuff. And that's the durable goods side, and that's where the majority of the inflation has been so far. So now that the economy is shifting back to services spending, the Fed wants to avoid a similar type of inflation dynamic on the services side at all costs. The way to do that, from their perspective, is they need to relieve the labor market of the current pressures that currently exist. The labor market cannot be this tight, and so they want to engage in tighter monetary policy and ultimately drive people back into the labor market and increase the labor participation rate so the wage pressures come down and therefore lead to some temporary relief on the inflation front, driven by a lack of services inflation and some disinflation on that front. So yeah, that's definitely another dynamic we're watching here.
Services inflation, that's really interesting. You put it that way, right? I mean, it's interesting because you had, I think the UK just announced a 6-month trial. I forget how many companies it was, but they're trying a 4-day work week. Do you think somehow that's correlated?
It's probably by the demands of the workers, and I mean, ultimately, that's inflationary too. Because if the workers are in the office less days, then you need more workers, or you offer higher wages to get workers back into the office. So it's certainly interesting, and it goes back to that wealth gap of there's a vast disparity between the income that the top 1% make and the bottom 50. That's ultimately leading to more polarization in society as a whole. But without getting into politics here, it's just something really important to watch for the commodities and financial space at large.
Yeah. It's interesting what, earlier you said, like, regardless, the Fed just can't, print, but maybe the Fed needs to somehow come out with a way to print some oil refineries. And then that would go right along with, with how, how everything's been working. But, clearly we know that's not possible. Hey, Jannis, that's all the time we have for today. This has been Macro Corner, Blue Line Futures Macro Corner. I am Paul Wankmueller. That was Jannis Meindl. We are going to be here every week talking about top things to watch to help you better trade the markets. Thank you again for joining me, and I look forward to hopefully having you on the show.
Thanks so much, Paul. Have a good one.
Have a good one.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.